Now we're going to turn to where are we sitting for the U.S. And one of the things that we always want to look at is that overview. So as we were saying, we expected to come just below that 2019 level on average, and we're right there. We're just above 15 million on the 4-week rolling average. So as we saw that big spike, we expected to see that drop. And now we expect to see it stay just below that 2019 level. We should get a nice spike in gasoline, but distillate will start to cool off, and that's due to heating oil and some of that seasonal slowdown that we normally see from the diesel side. And then we'll get a little bit of a rally as we go into year end. It's just going to be a matter of kind of where do we shake out. And you can see just how it is fairly normal for where we sit. So it's just, again, as we've been saying, just below normal due to where gasoline is, where jet fuel is, and then where disti will be on the short term. The current week was 14.72 million barrels a day of demand. Last week was 16.254. So again, the average out. So then the average for the 4-week rolling was 15.092 million barrels a day. So still fairly stable right here. You know, we're not seeing too much move up or down. And that'll keep the remain just as we get some offsetting. We will get an increase in distillate just because we had a big drop, and then we will get some of that bounce in gasoline just given where the demand is so far this week. But then you'll have some of that drop off. So it's just going to be a matter of how big is the increase versus the drop off, and based on where we sit, because we do have Christmas Day as a weekend. As a Saturday, so that means Friday is off, so we should get that bigger increase as we go into Wednesday and Thursday, and then that steep drop off, and then we should have a fairly low weekend. You know, just because people are there, they might extend the weekend, and then you might see people stay through the end of the week, just because then you get New Year's Eve on a Friday, which means that you have off on Friday and Saturday, Friday as well. So again, you're going to see some of this little adjustments so that's why we think we'll stay just below normal when you look over from 2019 through from 2017 to 2019, and you normally see that steep drop off. We had it in 2017, we had it in 2018, and 2019 we never really had that increase, and we expect that to be fairly normal, and we expect to see some of that averaging out at that level. So the reason why, when we look at what is to come, distillate had a small build of 400,000 barrels. You can see that that's 11.3 million below the 5-year average. We had some small draws in pad 1, pad 2, a small build in pad 3 of 860,000. Again, that was enough to kind of offset and put us a little elevated. We did get a drop in imports by 247,000 barrels a day. That was driven by pad 1, which had the drop of 253,000 barrels a day. And we expect to stay fairly normal against the 5-year average, just given where the dynamics sit. And we do see, a little bit of an overhang on exports. We did get a bounce, but as we were saying last week, we've had some weird moves, and we did expect a bounce. It was right in line with where we thought the bounce was going to be, and then we think that we have a drop off through year end. And it's just given the amount of demand that's sitting there, we still have a lot of spare capacity in storage. And and based on where gas oil spreads, they've continued to strengthen in Europe. So we'll see a little bit more, again, on the import side, get capped in Europe. We'll attract some additional from the Middle East and Asia into Europe as the U.S. continues to stay fairly capped in terms of where exports are going to go. Demand dropped. You can see that it dropped a little bit earlier. And again, that's why it's a little sloppy in terms of when you get some of these increases. So typically it's next week's drop. Instead, it was this week. We do expect to see a little bit of a bounce, but a lot of people are trying to get home for the holidays, especially on the truck driving side, after people have been, trying to bust their hums, trying to get all this stuff, and the supply chain caught up. And then we do have a little bit of warming, which will be an overhang for some of that heating demand, but keeping us fairly tight to that 5-year average. As we were saying last week, we expected a spike of trucking demand. We got it. We were expecting it to come to about 150. It came in at 145. And now we'll see a little, that drop for the holidays, and then we'll see a little bit of that rebound. And then we're going to start off January next year very strong. You can see load availability is elevated. We're starting to see a little bit of a drop in rates, and that's just because we've had another nice decline in diesel, which has taken some of the pressure off. But that's something that is continuing to be a broader overhang. When we look at trucking, at rail, total carloads are up 1.7% versus 2020. As we said last week, we expected to see a bounce in intermodal. We got it. We're only 6.9% below where we were versus this year, versus last year, which is a little bit closer to normal. Still a little bit of a decline, but again, getting much closer to that normal level. We had a drop in motor vehicle parts, not surprising. Grains, that's again just because last year was so big. We still have a lot of movement, but last year was one of those outlier years. And then everything else remains elevated. So we do expect to see, again, rails remaining fairly robust into year end, and then kicking off 2022 very strong, just given where we are on inventories and general supply chain congestion. And there's the vessels to prove it. We still have a lot of backlog. You can see that there's that drop going into Christmas week, but then as soon as we get out of Christmas week, you get that big increase. It remains elevated, and then we start off January well above where we started off the previous week, the previous year. So again, you're seeing a lot of these cargoes stuck offshore, still struggling to come onshore and keeping us fairly elevated. That's not going to change. PPI surged again to a record across Europe. We're seeing it surge again in Asia, which is going to keep our imports expensive. We are seeing a drop in dry bulk shipping prices. The rates are coming down as we are getting some semblance of balance, but now we have, again, more ports that are being disrupted in China. So we will see that flatline a bit, but still remain below peak, but still remain elevated when you look at it versus historics. Here's some of this heat wave that we're talking about coming through, essentially from New York south. So that's that, and then you have fairly normal demand when you're looking at New England. So and then we have some below average temperatures in the north. So when you're thinking about the balancing act, net will have a little bit less heating degree days than normal, and then that continues into the first week of Jan. So we will have some of that warmth, which will decrease some of the propane and heating oil, which again will put a little bit more in storage and keep demand fairly capped. On the the gasoline side, we had an increase of 5.53 million barrels. We're now 9.3 million below the 5-year average. You can see that there was an increase literally across every pad, with an increase in blending components of 4.17%, 1.7 million barrels. That's 3 million below the 5-year average. So that's where we think we'll shake out. We have getting much closer to a little bit, that normal level as we go into year end. Imports increased 190,000 barrels, as we were expecting a little bit of an increase, a little bit more than what we thought was going to come in. We thought we were going to be about 550 to 575. We came in at about 688,000 barrels a day, which is 187,000 above the 5-year average. We thought it was going to be a little bit closer to just right in the 5-year. Instead, it was a little increase. Now we'll probably get a little bit of a decrease. Again, this could have just been pulling it forward ahead of Christmas. So that's where we just look at where we'll be today. We'll probably have a steeper decline, and it'll just try to marry and match up. So now when we think about what were the production rates, so production of gasoline dropped. It dropped by about 1.5%, where we had distillate essentially flat. So again, the shift remains trying to be close to seasonal normal. Distillate production, when you're thinking of it versus historics, is still just below 1% of normal, where yield for gasoline is right in line with historics. So this is where we expect to continue to close this gap and continue to see builds in gasoline storage as we go into year end. And then when you look at demand, remember last week we had a big drop. This week we had a nice rebound. So according to Gas Buddy, weekly U.S. gasoline demand rose 2.9% from the prior week and was 1.2% higher than the rolling 4-week. So you're seeing some of that increase, and then we've had some strong numbers as we go through Monday and Tuesday. Monday, demand jumped 6.8% from the prior Monday and was 4.8% above the average of the last 4. Tuesday reached its second highest tally for Tuesday in 2021, barely missing the Tuesday ahead of Thanksgiving, with demand up 5.8%. So when you look at gasoline demand as we go into Christmas, we expect it to really be soft, or start to soften on Christmas Eve and then really drop off for Christmas Day. And then you'll start to see some of that increase, really not on Saturday or Sunday, but more likely Monday, Tuesday, as people try to take that weekend. And then you'll get a little bit of an increase, but typically you don't get as much on New Year's Eve and New Year's Day. It's really that Christmas push. So then we'll see that drop off. So again, increase, and then that kind of the decline below where we normally are, and that's going to be due to people that have met with family, maybe want to take it a little bit easy after some increase in exposures. People obviously trying to get tested to make sure they are safe to see family, which is also going to see that increase in underlying testing in general. So then when you look at gasoline prices fell another 2 cents, right to $3.29.5. We expect that to continue to, remember, about $3.27 where we should be there as we close out the year, with another 2.5 cents to go. We had a drop of about two and a third cents of diesel. We're now at $3.62.6, and we expect that to get to about $3.60, but then it holds firm right around that level as we start to balance out in terms of that diesel moving through and some of that heating oil kicking back up in that first and second week of Jan. When we look at blending components, you can see that we're moving right in line with that. We had that little bit of a pause. Now we're getting that increase, and we expect to be just above where we were in 2017 and right where we were in 2020. We expect to be right in a very normal spot as we kick off the year, as blending needs have gone down, and gasoline demand, gasoline storage. Again, the gasoline yield has been fairly stable. We've had demand be fairly lumpy. We'll have another increase, but then we do expect to see that decrease into year end. And then here's when we look over the last 5 years, we're just below the 5-year average. When you're looking at where demand was this past week, we expect it to recover, but you can see that it's all about a matter of when you spike. We spiked a week early, we came down a week early, so we'll have that spike and then that drop off, and it all comes down to, again, that timing as to when do we close out that year. But we do expect to see something fairly close to what is normal. And then when you look at what happened last week, we had a spike above, to set as the headlines like to say, a new record. But again, it's just a matter of when that is. And now you can see that we're now below what is normal. So, but if you just shift it over a few days, you can see that we're very much in a normal backdrop. We expect to see, and then when you look at the chart direction, in 2019, we had a spike, and then it stayed elevated, came down a bit. When you look at 2016, it went sideways into the end of the year, and then for others, it dropped off. It's all a matter of timing as to when is this going to get struck. We expect to see a little bit of a bounce to 2016 levels and then a fairly steady drop off just based on that timing. And then we'll come in fairly light to kick off Jan. And the reason why is, when you look at activity, workplace had a little bit of a recovery that's going to drop off now. And then we expect to see a little bit of a lag in Jan just as people try to mitigate against exposures. And that'll keep work from home elevated as we go into January, and residential a bit elevated as people slow down. Retail, recreation, again, all of that leading to some of that slowness that we've been discussing. When we look at Apple Mobility, we got a nice little spike across the board. Europe is remaining strong. We expect that to drop off as cases continue to rise and we get some restrictions, but again, it'll be very regional. So far, there hasn't been any adjustment, which is a positive when you're thinking about how people are just saying, look, COVID is here. It's not as bad as it once was, especially when you're comparing it to cases versus hospitalizations and deaths. So people are feeling a bit more confident to still continue to go out. And that'll again drop off as we go into the holidays, firmly into the holiday itself. Propane had a draw of 850,000 barrels. That's 7.1 million below the 5-year average. Fairly, still above where we were in 2017 and 2018, which is a positive when you're looking at storage. But then when you look at it compared to typical usage, we've actually, just because there is more consumption now, on days of supply, you're still in a fairly bullish backdrop. So that's going to be something to look at as we go into year end, which is what we see here when we're actually below where we were versus 2017 and 2018 on the consumption side, because consumption, even though we're getting some slowdown due to a bit of a warmer weather, exports are still elevated. We still have a record amount of exports. And that is, again, keeping us fairly well contained, because days of supply is looking at what is storage and then what is consumption. And with consumption being up, that is helping bring down what that total supply looks like. Vaccination levels still remain elevated. That's going to still stay the case as people, try to get, their last shot in before the new year. And then we'll start to see that increase when you start looking at boosters as we go into next year. On the jet fuel side, you can see that there was a draw of 200,000. That's 4.4 million below the 5-year average. And as we said last week, we expected to see that move down in terms of demand to about 1.446. We were assuming about 1.45. We're right here. But then there will be a spike, as there normally is, just because there will be more flights. There will be more people taking off due to the holiday push. But when you look at it through historics, again, we're still well off the highs. That'll remain the case as people look to maybe avoid flying, drive instead. And that's putting a bit more cars on the road, a little bit less aircraft in the air. Still, it will just be, again, just off, we'll be about 300 to 400,000 off normal peak and about 300 to 400,000 off of the normal low. And we'll continue that. And that's something that we think will remain firm, especially when you look at what is normal as we go through, kicking off January into the beginning of next year. And then open table, when we're looking at activity, as we were saying, we expected to see an acceleration of declines during the week. We expected weekday to be about 15-20% below normal, and weekend 0 to 5% below normal. And we nailed it. We were right there, and we expect that to continue through the end of the year, and then and start off fairly slow in January, just given some of the increases in COVID, people, again, trying to reduce some of their exposures. So now that we've gone through what's happened in the U.S., we want to now look at what is happening abroad and where some of these shifts are in terms of force majeures and some of these demand shifts and movements on the crude and refined product level.